The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Climate Risk, Are Financial Regulators Politically Independent? Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 4 minutes to give an opening statement. Federal regulators represented here today have recently coordinated to promulgate principles for managing climate-related financial risks. The guidance and information requested by the regulators align with a 2021 executive order, efforts promoted by the Financial Stability Oversight Council, Chair Yellen, and recommendations from various international global governance organizations. The Federal Reserve is extending furthest with a mandatory supervisory climate scenario analysis and formal collaboration with Treasury's Office of Financial Research on climate data and analysis, which the Board of Governors never voted to approve. FSOC Chair Yellen has repeatedly identified climate change as an existential crisis and has called climate change, quote, an emerging and increasing threat to financial stability, unquote. Following the administration's posture on climate-related financial risk, regulators have begun inserting climate policies into bank regulation and supervision. There is little transparency about regulators' climate efforts and what occurs in administration-led climate working groups or international global governance organizations. 4 bills have been attached to this hearing to address this lack of transparency and regulatory capture. There is also lack of transparency about funding of some of the climate-related efforts of the international organizations, including the tangled web of financing associated with the network of central banks and supervisors for greening of the financial system, or NGFS. There is nothing wrong with regulators wanting to learn more about data methods and analysis or to ask questions of banks about what they're doing. No one believes that financial institutions should ignore not fully understood risks. But we and the regulators know that institutions are already analyzing climate-related financial risks, and many large institutions have public-facing information available describing how they are monitoring and managing this risk. Yet somehow, after an executive order was issued and FSOC made pronouncements, the regulators found a sudden need for a coordinated public-facing campaign of guiding principles for climate risks that research says are manageable. Regulators are saying that their efforts are intended to help banks manage risks that are not yet fully understood, even by the regulators, with the underlying premise that somehow the prudential regulators know better than the private sector. That seems odd, given that the Fed says that they must exercise humility about spotting risks, and they couldn't even help institutions manage interest rate risks. The Fed's Vice Chair for Supervision promises, as he did with Silicon Valley Bank's failure, to write a public-facing report of his personal assessment of what his climate scenario analysis reveals, using data that Congress will not be able to see to corroborate his findings. At best, existing climate-related financial risk analysis can show long-run directionality of financial and economic effects of alarming climate futures. But to think that existing analyses can accurately predict near-term effects of projected climate changes 5, 10, or even 100 years out is misleading and false advertising. Climate models are typically unwieldy mongrels characterized by cascading uncertainties as they mix and match inputs and outputs from economic, climate, ocean temperature, and other modules to produce questionable numbers with highly questionable predictive content. There are so many degrees of freedom available to climate analysts that, like cooking soup with a cabinet full of spices, you can get whatever flavor of results that you'd like. As Nobel Prize-winning economist Lars Peter Hansen counsels to regulators and central banks, quote, their credibility will be further enhanced by avoiding the temptation to exaggerate our understanding of climate change, unquote. On climate policy, driven by Biden administration directives, regulators are choosing politicized policymaking, putting their independence at risk and giving in to the temptation to exaggerate our understanding of climate change. The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Mr. Foster, for 4 minutes for an opening statement.
Thank you, Chair Barr, and thank you to our witnesses for being here today, and thank you to our regulators for appropriately and thoughtfully responding to the changing risk profiles of our financial systems. As our world changes, it's important that participants in our financial system remain well apprised of new and emerging risks, and it's important that our regulators help them stay well postured for those risks. History tells us that systemic financial risks do not come from politically driven overreaction to emerging risks, but rather from regulatory capture, properly defined, which is the use of the political power by economic incumbents who use their political power to restrict the ability of regulators to respond to new and real financial threats that powerful incumbents may find inconvenient to acknowledge. We saw that most recently in the financial collapse of 2007, which was preceded by more than 20 years of great moderation, a period lasting from about 84 to 2008, a period of low volatility and continuously rising asset prices, including home prices that rose faster than GDP, but also a banking system and a middle class that became leveraged beyond all reason, and an economy completely dependent on continuously rising asset and real estate prices, which was obviously unsustainable from first principles, just as it is scientifically unsustainable to continue putting greenhouse gases into our atmosphere without suffering severe economic consequences. However, in 2007, as well as many times in our history, the political power of economic incumbents encouraged or forced regulators to keep their heads in the sand. So instead of appropriately responding to what was then euphemistically called the subprime crisis at the tip of a much larger iceberg of systemic risk, in 2008, the Bush Treasury Department put out a blueprint for financial modernization, which incredibly proposed even further deregulation of an already shaky financial system. So the threat of political influence on our financial regulators is real. And climate change does pose systemic risks to our nation's financial system. The destruction waged by stronger hurricanes and tornadoes, more intense floods and droughts, sea level rise and wildfires threatens businesses, banks, and credit unions across our country. And when a large swath of a region's businesses or homeowners face major losses all at once, from one of these catastrophic weather systems, financial institutions that issue loans or insurance to them, in turn, must swallow large losses. And to maintain system-wide stability, the regulators must ensure that banks are able to weather these literal and figurative storms. Similarly, on the investor level, in order to effectively manage their own risks, shareholders must have access to information regarding a company's exposure to climate-related risks. We cannot allow Americans to lose their retirement savings because acknowledging the realities of climate change has been overshadowed by partisan politics. Federal financial regulators, including the SEC, have recently promulgated regulations to address system-wide and investor-level risks, and I applaud them for doing so. My Republican colleagues seem to have called this hearing to promote the idea that regulations represent a lack of political independence by the agencies, that they're responding to Democratic pressure to raise the alarm about the impacts of climate change. However, the true danger lies in the other direction, in a politically driven underreaction. And these rules simply recognize the reality of climate risk to our financial system. If hearings like this one end up pressuring regulators to bury their heads in the sand and ignore climate risks, it would create a grave economic distortion and risk unnecessary failure of our financial institutions and harm to ordinary Americans that inevitably follows. So I applaud FSOC and the SEC for following the science and considering the financial risks posed by climate change in spite of the political pressure. And I look forward to hearing from our witnesses today to show how we can further increase transparency and mitigation surrounding financial institutions' climate risk.
The gentleman's time has expired. The chair now recognizes the chair of the Subcommittee on Oversight and Investigations and leader of the Environmental, Social, and Governance Working Group, the gentleman from Michigan, Mr. Huizenga, for 1 minute.
Thank you, Mr. Barr. Appreciate you allowing me to attend. And well-intentioned but misguided government mandates are nothing new in Washington. However, the radical shift by this administration to pound ESG policies into every facet of our society outside of the legislative process has reached a critical breaking point. As banking regulators continue to push for the disclosure of climate-related information of which they have little or no experience with, small businesses as well as low and middle-income families across the country continue to be crushed by soaring costs stemming from President Biden's failed economic agenda. Instead of feeding their obsession to become climate policy makers, often picking winners and losers, regulators should focus on sound banking policy that won't impede America's drive for energy independence and increased economic opportunity for all. Republicans won't idly stand by and allow banking regulators on their own to channel credit to politically desired sectors, bypassing Congress. So thank you, Mr. Chairman, for allowing me to join your subcommittee, and I look forward to hearing from the witnesses.
The gentleman yields back. The gentlelady from California is not here, and so we will move on to a witness testimony. Today we welcome the testimony of Mr. Greg Coleman. Mr. Coleman is the Senior Deputy Comptroller for Large Bank Supervision at the Office of the Comptroller of the Currency. Ms. Doreen Eberly. Ms. Eberly is the Director of the Division of Risk Management and Supervision at the Federal Deposit Insurance Corporation. Dr. Michael S. Gibson. Dr. Gibson is the Director of the Division of Supervision and Regulation at the Board of Governors of the Federal Reserve System. Mr. Rendell L. Jones. Mr. Jones is the Deputy Executive Director at the National Credit Union Administration. And the Honorable Sarah Benatar. Ms. Benatar is the Treasurer of Coconino County, Arizona. Welcome to Washington. Thank you for being here. Thanks to all of you for your service and for taking time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mr. Coleman, you are now recognized for 5 minutes to give your oral remarks.
Chairman Barr, Member Foster, and members of the subcommittee, thank you for the opportunity to appear today to discuss the Office of the Comptroller of Currency's activities around climate-related financial risk. The OCC is an independent bureau of the Department of Treasury, and its mission is to ensure that national banks and federal savings associations operate in a safe and sound manner, provide fair access to financial services, treat customers fairly, and comply with applicable laws and regulations. Consistent with that mission, one of the OCC's current priorities is acting on climate risk due to the increased frequency, severity, and volatility of weather events which affect the value of financial assets, borrowers' creditworthiness, and the associated risks banks may take onto their balance sheets. Our focus for this priority is on the largest banks. I'd like to stress that the OCC does not and will not tell bankers what customers or legal businesses they may or may not bank. Rather, we are committed to staying focused on banks' risk management of climate-related financial risks. This focus is firmly rooted in our mandate to ensure that national banks and federal savings associations operate in a safe and sound manner. The OCC has approached climate-related financial risks the same way the agency approaches any emerging risk area, to work with our regulated institutions to determine if they have appropriate processes and procedures in place to address the risk. In December 2021, the OCC issued for public comment draft principles designed to support the identification and management of climate-related financial risks at OCC-regulated institutions with more than $100 billion in total assets. Limiting the scope of the guidance to large banks, which have already begun to monitor this emerging risk, is intentional because their exposures to climate-related financial risk may be material. The draft principles describe general considerations relating to bank governance, policies, procedures and limits, strategic planning, risk management, data, and other areas. They provide considerations for how climate-related financial risk can be addressed in the traditional risk categories, including credit, liquidity, operational risk, and others. The agency has invited feedback on all aspects of the draft principles, and we are continuing to work and continue to consider the comments received. We are working with our interagency colleagues to determine the next steps in this area. On their own initiative, large banks have begun incorporating climate-related financial risks in their risk management frameworks and policies. To understand their climate-related financial risk management programs, the OCC began reviewing this information in 2022. My testimony describes our initial observations from these reviews. In general, the large banks we supervise are in varying stages of developing processes to measure and monitor their potential exposures to physical and transition climate-related financial risks. I stress that community banks are not the focus of our climate-related financial risk efforts. Based on decades of experience in their local communities, community bankers are very familiar with the impacts of weather events upon their customers and business. Further, these banks have long managed the risks that localized weather events present. The OCC does not intend our efforts aimed at the large banks to trickle down to community banks. However, Acting Comptroller Sue has suggested that mid-size and community bankers be mindful of these risks and give thought to how they can continue to manage them appropriately. To ensure that the OCC is aware of the climate-related financial risk management efforts of other federal government and international bodies, the agency is a member of the Financial Stability Oversight Council's Climate-Related Financial Risk Committee. We also participate in the Basel Committee on Banking Supervision Task Force on Climate-Related Financial Risks and the network of central banks and supervisors of greening the financial system. Our efforts with these international bodies allow the OCC to ensure awareness of and facilitate information sharing with our fellow regulators. In closing, the OCC is committed to assessing climate-related financial risks at banks with over $100 billion in consolidated assets from a risk management perspective. This approach is consistent with how the agency responds to emerging risks to the banking industry and to ensure that national banks and federal savings associations continue to remain safe and sound, provide fair access to credit, and treat customers fairly. Thank you, and I'll be happy to answer your questions.
Thank you for your testimony, Mr. Coleman. And Ms. Eberle, you are now recognized for 5 minutes to give your oral remarks.
Thank you, Chairman Barr, Ranking Member Foster. The agency carries out this mission through its responsibilities for deposit insurance, banking supervision, and the orderly resolution of failed banks, including systemically important financial institutions. The agency's role with respect to climate change is centered on the financial risks that climate change may pose to the banking system and the extent to which those risks impact the FDIC's core mission and responsibilities. My testimony today will provide a general discussion of the FDIC's understanding of climate-related financial risks, the FDIC's efforts to collaborate on this topic with other federal agencies, industry stakeholders, and international organizations, and the agency's first steps to support financial institutions as they develop plans to identify, monitor, and manage the financial risks posed by climate change. There's broad consensus among financial regulatory bodies, both domestically and abroad, that the effects of climate change and the transition to reduced reliance on carbon-emitting sources of energy present unique and significant economic and financial risks, and therefore an emerging risk to the financial system and the safety and soundness of financial institutions. The financial system has always had severe weather events to contend with, and thus far the banking industry has handled these events well. However, changing climate conditions are bringing with them challenging trends and events, including rising sea levels and increases in the frequency and severity of extreme weather events. In addition to these physical risks, transition risks may also pose material risks to the financial condition of banking institutions in several ways. Transition risk generally refers to stresses to certain financial institutions or sectors arising from shifts in public investment, consumer and business preference, or technologies associated with the transition toward reduced carbon reliance. These trends present emerging financial risks to the safety and soundness of financial institutions. And the goal of the FDIC's work on climate-related financial risk is to ensure that the financial system continues to remain resilient despite these rising risks. I would emphasize to the subcommittee that the FDIC is not responsible for climate policy and will not be involved in determining firms or sectors with which financial institutions should do business. These types of credit allocation decisions are the responsibilities of financial institutions. The FDIC's approach is centered around having financial institutions fully consider climate-related financial risks as they do all other risks, and continue to take a risk-based approach in assessing individual credit and investment decisions. In order to understand and address the financial risks that climate change poses to financial institutions and the financial system, the FDIC has undertaken efforts to foster an open dialogue with our counterparts in the U.S., with international financial regulatory bodies, and especially with stakeholders throughout the banking industry. The FDIC is coordinating with our interagency peers, is participating on the Financial Stability Oversight Council's Climate-Related Financial Risk Committee, and has joined the network of central banks and supervisors for greening the financial system with the Federal Reserve and the Office of the Comptroller of the Currency to foster collaboration and share best practices in addressing climate-related financial risks both here and abroad. This complements our existing work with the Basel Committee's Task Force on Climate-Related Financial Risks. While the FDIC remains in the early stages of addressing climate-related financial risks, regulators need to work with the banking industry now to support financial institutions as they develop plans to identify, monitor, and manage financial risks posed by climate change. This collaboration should be conducted in a manner that is flexible enough to allow for change. As knowledge is gained, data are developed, and new methodologies and tools are explored. Consistent with this approach, the FDIC issued a request for comment in April 2022 on draft principles that would provide a high-level framework for the safe and sound management of exposures to climate-related financial risks for large financial institutions. The principles take a risk-based approach and are consistent with the risk management framework described in existing FDIC rules and guidance. Comments received on the proposed principles are currently under review and consideration, and the FDIC is working jointly with the OCC and Federal Reserve to finalize and issue joint principles later this year. The FDIC remains committed to engaging with the public, industry stakeholders, and members of Congress, on the issues outlined in my testimony. I look forward to answering your questions.